So if I'm interested in purchasing a home, how much should I put down
Great question.
for a down payment?
Great question. As you know, there are different products that have different perks. And so VA product allows for 0% down, which is great. FHA allows for as little as 3.5% down. And conventional, in some cases, allows for as little as 3%, and in most cases, as little as 5%. So, which is great. But we also want to consider how much down, how much a borrower puts down impacts their monthly payment, right? So, so the more money that you put down as your down payment, the lower your monthly payment is going to be. And so, that really impacts your affordability. So, and to answer your question, I would say that it really depends on their monthly budget and also the ability and that they have to increase their down payment.
Right, because
Okay.
you want to have some reserves. You don't want to put all of it up front, but
Right.
you also would love to get that monthly payment down.
Right, right. And then you have, if you're using conventional financing, you have that layered consideration of private mortgage insurance, or PMI, and that's also going to be metered by how much money you put down. So the less you bring as down payment, the higher your private mortgage insurance premium is going to be. And the more you bring down, upwards to 20% when you no longer have to carry private mortgage insurance, it's lower the amount of PMI that you have on your payment.
Right, okay. Yeah, because I had a cousin that asked me recently about, because he has a conventional loan and he was curious, he thinks he's almost to that 20% where he's paid off of that, the principal. And so he was curious how to get rid of the private mortgage insurance. So does that PMI, does it go away once you hit that 20%, or do you need to reach out to your loan officer and say, yo, I'm at the 20% mark, let's get rid of this thing?
Right. Well, that's so typically, yes, there is a certain point where your lender is actually going to call you or send you a letter that says your private mortgage insurance will fall off next month, or so that is true if you hold it long enough, if you hold that loan long enough. Typically, and not always, the value of our homes increases at a quicker rate than it would take for you to allow the private mortgage insurance to fall off automatically.
Oh.
So you're in a position oftentimes where you can refinance to get the private mortgage insurance off, or
Right.
the PMI off. And that typically happens sooner than if you would just hold on to that same mortgage for the long term.
Oh,
Not always, but
yeah.
definitely something that you should stay in touch with your lender and monitor.
Right.
Yeah. So the PMI naturally falls off at 20%. You can refinance, but also, and this is more relevant to a seller's market where you have to keep your offer very competitive. Contingent offers aren't as popular, and so we were seeing some of our buyers actually bring in a really low down payment because they were trying to buy before they were selling their previous home, their departing residence.
Right.
And then they wanted to use the net proceeds from the sale after they closed on their purchase to go towards, creating a more affordable payment for them. So, and so in those cases, you can actually do recast. So when you have a large sum of money and you don't want to refinance because you have a good interest rate, a competitive interest rate, you can reach out to your lender and you can put that large lump sum of money down, and they can recast your loan at that same interest rate without having to refinance, so that your monthly payment is lower.
Wow.
Yeah.
So it's basically refinancing without having
The cost.
the cost.
Right.
Right.
And you don't have to you don't have to recapture a market interest rate. Now you can keep.
You've already locked it in.
Right. So you can keep that interest rate.
So how long of a time do you have to make that large payment and to like recast from the purchase of the home or from closing?
Well, you can usually, there are requirements, so it has to be a certain amount of money, and it's different with every investor, and not all investors allow it. But you can reach out to them at any point in your in the loan period, and you can ask that they do that. And there's usually a nominal fee, but nothing like the cost of a refi.
Right. Oh, wow.
Yeah, yeah. And also with a recast, you can, if you get to that 20% magic number and you weren't there before, you can have that PMI removed as well.
So with the different types of mortgages, what are the differences between like an adjustable rate mortgage and a fixed rate mortgage?
Right. So a fixed rate mortgage is something where you are offered an interest rate and you close on that loan, and that is your interest rate for the life of the loan. So your principal and interest payment portion of your payment is going to stay fixed, hence fixed rate for for 30 years or 15 years or for the entire term of that loan.
Gotcha.
And then adjustable rate mortgages are fixed for a certain amount of time. And so when you see them advertised, you'll see a 3-1 arm or a 5-1 arm. And that means that for that 3 years or that 5-year term, the first 5 years of the loan, it's going to be fixed at the agreed amount, the agreed interest rate. And after that 5th year has come and gone, then that first year, typically it can adjust, and there's usually a max amount of points that it can adjust. And in most cases, it's going to be 2% for the first year. And then an adjustable rate mortgage has a lifetime cap as well. And it can vary depending on the product and the investor, but we see most often that it's 5 years or 5 points.
Okay.
Cap, lifetime cap.
Okay. And so are you seeing anything, this year or from last year, any differences between, which products are more popular?
Yeah. So we're coming from, an amazing few years where interest rates were very low, and there was really no reason for adjustable rate mortgages because why would you pay for a what might be considered more risky loan when you already know what you can get a 3%, 3.5% interest rate, without having to deal with an adjustable rate mortgage. Right. Now, because the market is a little more volatile, we're seeing investors not pushing the adjustable rate mortgages as much, so they're not making them as attractive for buyers because they don't want to. They don't see the benefit, the payoff in an adjustable rate mortgage. Because they're anticipating that interest rates are going to relax, and most people are going to want to refinance out of it sooner than they would have their break-even point as an investor on that.
Right. Okay. So with like the different types of loans, like the VA and the conventional and the FHA, what is the news that came out about the FHA loan?
FHA, VA are government loans, and so FHA announced that come next month in 2023, April of 2023, they're going to be lowering their mortgage insurance factor, and so that's a great opportunity for clients that have average to good credit scores that would gravitate towards an FHA loan. It means that their monthly payment is going to be a lot more affordable. So recently, historically, if the down payment minimum for FHA is 3.5%. So for a client that is going to buy a home and bring 3.5% down, their mortgage insurance factor is 0.85%. So that's going to change now to 0.5%. So really big, big difference. And I, for fun, yesterday kind of did the math on a theoretical client that had a 680 credit score and that came to me and wanted to use FHA financing. And that same client came to me and wanted to use conventional financing. And the mortgage insurance, the private mortgage insurance premium that you have to get with a conventional financing was near that 0.85% for a client with a 680 credit score.
Okay, wow.
But FHA, the mortgage insurance factor is fixed, right? It doesn't matter what your credit score is, so it's not credit score driven. And so, a client at a 640, at a 680, at a 700 would have that same mortgage insurance factor. So a client that has a lower credit score is going to see the clear benefit of that lower MI that FHA has announced. And VA has also made an announcement that they're lowering their funding fee for veterans. So that is, that's a win as well for our veteran population.
And what is the funding fee? Is that a closing cost?
Yeah, so the funding fee is technically a closing cost. It's a cost that that the VA charges, and typically what I see most frequently is the veterans finance it into their mortgage. They're able to do that. So you can bring it in as part of your down payment, or I'm sorry, as part of your closing costs, and bring cash in to pay for it. But most notably, we see veterans financing it, and so they have brought that down some across the board. So that means the VA payment will be a little bit lower.
Nice.
Yeah.
And I know that you've mentioned about, like, Penrith has a program, like if you do want to refinance, but there's a little special incentive there.
So right, so it is our rate protection program, and we're seeing a lot of clients coming to us that are hesitant to make the decision to move forward and make an offer on a home because of the current rate environment that we're in. And so this rate protection program, it allows them to refinance when rates start to relax, and we are going to take care of a good portion of the cost of that refinance and the appraisal fee as well. So, so it's a great opportunity to, for our clients not to feel the pressure of having to live with their monthly payment now at these higher interest rates that we're seeing, knowing that, there's a light at the end of the tunnel, and when that time comes, it's not going to cost as much for them to get into that lower interest rate.
That's awesome.
Yeah. Penrith also has our certified buyer program as part of that, which, are you familiar with the certified buyer program?
Right.
So our certified buyer program is something that we offer because we want to encourage all of our clients to go through underwriting completely before they make an offer, and that's just to ensure that their stress levels are lower, to ensure that the transaction moves smoothly and as successfully as possible. So when they're completely through underwriting, we issue a guarantee that we have the buyer's agent submit with their offer, and comes equipped with the seller's names on it, and written to them, and letting them know that if we don't close on time per the contract, that we're going to write a check for $5,000 to the seller.
Cha-ching.
Yeah, so we're starting to see that swing again, where homes are moving, and we're starting to see multiple offers again.
Right.
And so it just adds that cherry on top,
right,
to let that seller know that we're ready, and we're putting money on it.
Yeah, much more enticing in a multiple offer situation.
Exactly.
For a seller. Yeah, absolutely.
Yeah.
That's cool.